Hey everyone, today we're going to be talking about one of the most common reasons you should make Roth conversions part of your retirement tax strategy. And that's to minimize required minimum distributions, otherwise known as RMDs. Now, before getting into the meat and potatoes of this presentation, if this is your first time on our Safeguard Wealth Management YouTube channel and you like the kind of content that we put out, okay, you like some of these videos that we have in this Roth Conversion series that we've been putting on for the last few weeks, go ahead and hit the subscribe button. We release content weekly. You'll be notified of all future content that we release. So let's talk about RMDs and how Roth conversions can help you avoid this tax problem. Now, it's important to understand that RMDs are often not a tax problem in and of themselves. Okay, yes, you will owe taxes on the RMD, and that can put you into additional higher tax brackets. But RMDs also create a cascading effect, where not only will you owe taxes on the RMD, but it can cause you to take tax penalties in other parts of your retirement, thus raising your marginal tax bracket. So we're going to be talking about how to avoid this cascading RMD tax trap. Now, what I first want to do is go through a very bird's eye view scenario of what I believe isn't an exceptional or outstanding RMD case. In fact, it's a fairly typical case that we see in our practice, and it creates an RMD tax bomb that can raise your marginal tax bracket a lot higher than most people think. Okay, so we have a couple here. They ended 2020 with an IRA balance of $896,000. Now, in the first couple of years of their retirement, pension and Social Security income covered the majority of their income needs. So they hadn't been pulling from that IRA account. And thus, it's just been growing unencumbered. But now they're 72. And so they're going to be forced to take required minimum distributions. We'll talk about what that is in a sec if you're not sure. But essentially, they're going to be forced to take $35,000 from their retirement assets. And remember, they don't need this money. And so they're just going to end up owing additional taxes on money that they don't need. And so this money was previously essentially tax deferred, tax protected. Now they're forced to take that money out, pay taxes, and it's going to be very tax inefficient. Now they're in the 12% tax bracket. So this RMD is going to push them into the 22% bracket. So they're first on this, the taxes on this RMD, they're going to owe at 12% and 22%, which is going to translate to them owing $6,275. But they're on Social Security. So additional tax deferred withdrawals from this RMD are going to force their provisional income higher, which is going to force more of their Social Security benefit into being taxed as well. So they're going to owe an additional $5,333 in additional taxes on their Social Security benefit. So in total, from this $35,000 RMD, they're going to owe $11,600, which translates to about a 33.2% tax just on this RMD. And so out of this $35,000 RMD, they're only actually retaining about $23,400 of it. Okay, and this isn't including state tax. If you live in the great state of Wisconsin like we do, you can tack on an extra 6.27%, which makes their marginal tax bracket almost 40%. Okay, and so this is a situation where earlier in their retirement, they could have been converting at the 10% bracket, the 12% bracket, the 22% bracket, the 24% bracket, even the 32% bracket, and it still would have been, they would have been paying less in taxes than they will be paying on this RMD. So their goal should have been essentially to almost eliminate completely this RMD. And so again, we see a small RMD, a relatively small RMD, can cause them to owe, again, if they live in Wisconsin, almost 40%, giving away 40% of that RMD to taxes. And so there's a little tax secret that the IRS has essentially given you, and thus translated them receiving more in taxes down the road. Okay, so let's talk just conceptually how tax deferred accounts work. Okay, when you put money into a tax deferred account, which would be a traditional IRA, a 401k, a 403b, okay, you get a tax deduction in that given year. So let's say that you put $10,000 as a contribution into your 401k in a given year. Well, your taxable income in that year is going to lower by $10,000 because of that deduction. And so that money, you get a deduction when you put that money in. Okay, it grows tax deferred. But then the IRS eventually is going to get their tax dollars out. And they get those tax dollars out when you withdraw that money. Okay, you're going to owe taxes when you withdraw that money for income, typically in retirement. And so that tax deduction comes with strings attached. Okay, yes, they give you a tax deduction. They let you take all of the risk of growing that money. And then down the line, when you take that money out, they're going to get their taxes. But they also realize that, okay, if we don't require anybody to take money out, there are going to be a lot of people who don't need that money in retirement that are essentially going to be able to defer that money, continue to defer that money without paying taxes, even passing that money on to the next generation. So they implemented something called RMDs, Required Minimum Distributions. So now at 72, you have to take that money out. You have to take a percentage of that money out each and every year. The IRS mandates it. Okay, and it's based on a formula, and this formula adjusts around your age. So the older you are, the more they're going to force you to take out. And it's very important that you follow these RMD rules, because if you don't, there is a 50% penalty for non-compliance. So let's say that you had a $15,000 RMD, but you didn't take it in a given year. Well, you're going to now owe $7,500 as a tax penalty for non-compliance. And so just know that that tax deduction while you're working comes with some pretty serious strings attached. Okay. And so it's very important, as we've talked about in previous videos, that when you tax plan in retirement, you need to plan well in advance of the problem. So many of us are used to, in our normal lives, procrastinating on problems and dealing with those problems when they come. I'm certainly guilty of it in certain areas of my life as well. Well, you cannot do this when you're tax planning in retirement, because the first essentially set of years of your retirement are some of the most important to save on taxes. The reason why is because once RMDs start, they're very difficult to deal with. Okay, so in this person's situation right now, the first, almost 10 years of their retirement, okay, they're going to need to plan for taxes essentially for the next 10, 20, and 30 years of their retirement. So they need to plan over here in order to save on taxes over here. And so again, this requires a lot of forward-looking tax planning. And it's difficult for many of us, because in so many areas of our life, we're able to deal with problems as they come. Well, in retirement tax planning, you simply can't allow problems to arise and deal with them then. You have to plan well ahead of time, okay? And so part of the reason, part of the problem is that RMDs are a growing problem if left unchecked. So let's say we have a couple here, and let's look at $1.2 million in a traditional IRA 401k balance, and let's look at how much they would owe in RMDs based on differing ages. Okay, so at 72, they would owe $46,000, or they would be forced to withdraw $46,000 because of this RMD. But 8 years later, when they're 80, that number jumps to $64,000. Okay, 5 years later, it jumps to $81,000. 5 years later, it jumps to $105,000, then $139,000. Then by the time they're 100, okay, if they're lucky to live that long, they're going to essentially be forced to take almost $200,000 out of this $1.2 million 401k tax-deferred balance because of RMDs. Again, this formula, it grows. The amount that you have to take out grows with each passing year that you age. And so this is a perfect example of why RMDs can't be left to deal with them as a problem once you turn 72, because once they start, they're going to continue to grow throughout your retirement. And so if you're in a tax problem at 72, you're going to be in a tax problem likely for the rest of your retirement. Now, there are some ways you can deal with them once they've started, but they're certainly less optimal than dealing with them well in advance, okay? And so part of the reason we talk about RMDs being a cascading problem, because again, RMDs themselves, even if they push you into the next tax bracket, it isn't the end of the world typically. The problem is created when RMDs push you into other tax hurdles that we've talked about. Okay, so before this couple turned 72 and were forced to take RMDs, they had $85,000 of retirement income. Okay, they were in the 12% tax bracket because of this. But they have some very large IRA balances. So that $85,000 of retirement income came from Social Security, it came from pensions. Okay, and so again, they haven't been taking from their retirement assets because they haven't had an income need in order to take from those retirement assets. So these large IRA balances have continued to grow. Okay, and now once this couple turns 72, they're going to be forced to take some pretty significant RMDs. In this couple scenario, these RMDs are going to be six figures. And so what's going to happen? What kind of tax problems are they going to face because of these RMDs? And remember, these RMDs are going to grow through their retirement. Well, tax bracket hikes is the most obvious. They're going to be forced into the next tax bracket, potentially even into the next tax bracket being the 22%, potentially even into the 24%. Okay, it's going to force more of their Social Security benefit to being taxed, which is going to cause them to be put inside of the Social Security Tax Torpedo, which we previously recorded a video on if you don't know what the Social Security Tax Torpedo is. It's going to force them into capital gains bump zones. So previously they were in the 0% long-term capital gains brackets. They're going to be forced into the 15% bracket. That's going to create different tax problems as well. Again, if you make too much, there's something called IRMA. Okay, it's Medicare-related premium adjustments. So their premiums are going to go up in relation to Medicare. Net investment income tax, that's an Obamacare surtax, 3.8% if you end up making too much. Okay, widow penalty and trap. Okay, we previously, again, recorded a video on how Roth conversions can help you avoid the widow trap. Well, the widow trap is often created because of RMDs. And then finally, the Tax Cuts and Jobs Act expiring. Right now, we are in a window of opportunity where taxes are lower than they will be in the future. After 2025, the Tax Cuts and Jobs Act is set to expire. So they might be in the 12% tax bracket right now, but they're soon going to be in the 15% bracket because of the Tax Cuts and Jobs Act expiring. Well, those large RMDs are also going to force them into higher brackets. And again, those brackets are going to even be higher than they are now, again, because of that Tax Cuts and Jobs Act expiring. So again, we see how an RMD, in and of itself, the only risk really is the tax bracket hike. But we see it cascades into all of these other tax problems as well. Okay, and so we've talked about before the need to know what your tax brackets look like going forward into the future. Okay, this person, again, before RMD started, between pension income and Social Security, their normal income goal was right here. Okay, on top of Social Security, their pension was around $28,000. Okay, and they were in the 22.2% bracket. Again, this is the Social Security Tax Torpedo that we're looking at. Okay, and so they were just taxed a little bit here at 22.2%, and then before that at 18.8%, and so on. And the problem is once RMDs start, okay, these RMDs are going to push them through the worst part of the Social Security Tax Torpedo over here. Okay, they're going to have essentially a $60,000 RMD. Okay, and so what's going to happen? Well, they're going to continue to be taxed in this area here at 22.2%. But then they're going to be taxed at 49.95% because of the bump zone that's created in addition to this tax torpedo. Then they're going to be taxed at 40.7%. And then again, they're going to be taxed here at 22% again. And so this RMD is going to force them to be taxed at different marginal rates, each of which are going to be much higher than they previously or intuitively thought. And so again, this is why it's so important to know what your tax bracket looks like going forward in the future. We know that if we estimate RMDs are going to be this large, we should be doing conversions well ahead of time to minimize these tax-deferred accounts, to completely eliminate this RMD. Ideally, making sure that their normal income goal stays their normal income goal. So in this scenario, we might completely be eliminating RMDs because we have some serious tax implications because of these RMDs. Their marginal bracket, again, is going to raise quite a bit higher than they intuitively think. And so there are some complications that arise when you estimate your RMDs. So if you've watched a few of our videos, you know that when we plan for retirement, we plan under 1,000 simulations. And why do we do that? Well, we have no idea what future returns are going to look like through the stock market, through other asset classes, and really nobody does. And so rather than looking at one scenario, which most of the time advisors just look at history and assume the future is going to look like the past. Well, we know that's highly unlikely to be the case. And so we run 1,000 different simulations because we want 1,000 different scenarios where we can plan and estimate RMDs, estimate if their retirement will be successful, estimate all of these different things, estimate what kind of problems arise throughout the retirement with different market returns. And so RMDs are a perfect example that fit into this mold. So let's look at a bad trial, assuming market returns are lower than they were in the past. And so this is a situation where this couple has some very significant pensions. Okay, and so with pensions and Social Security, their income is largely covered. But they also saved quite a bit into tax-deferred accounts while they were working. Okay, and so we see in a bad trial where market returns are lower than they were in the past, RMDs become a problem, but they're a problem that we can address. Okay, these RMDs in 2038, when both of them start, are 72 and they both start RMDs, we see that their RMD is estimated to be $66,647. But remember, this is a bad trial. What happens if market returns going forward in the future are like past returns or even better, slightly above average than past returns? Well, in a good trial, when they're slightly above average, we see that same RMD, rather than being, what was that, $66,000, is now going to be $171,000. So again, this is an important reason that we plan under 1,000 scenarios. We want to know what tax problems look like in multiple, essentially different scenarios. And so again, this is a huge problem now. Now we see these RMDs pushing them well into the 28% bracket and even into the 33% bracket going forward into the future. And so oftentimes when we have videos like this, people that see they're going to have an RMD problem, they oftentimes ask questions in the comments, and they ask for what I would consider the wrong solution. Okay, and so oftentimes we see, hey, someone say, hey, I'm going to just leave my tax deferred assets in cash then. We know that if we grow those tax deferred assets, well, guess what? Those RMDs are just going to grow into a bigger problem. So if I just leave that money in cash, that money won't grow, and that's a way to minimize RMDs. And that is a way to minimize RMDs, but that's kind of akin to turning down a raise while you're working because it might force you into the next tax bracket, right? That doesn't really make sense on the surface because we know even after that raise, we're still retaining more wealth. Even though we're paying a little bit more taxes on that raise, we're still retaining more wealth. So what I would urge many of you to do, and again, the reason I have these in quotations is because there's a lot of different goals that people have. Sometimes leaving that money in cash can be the right solution, but most of the time it's the wrong solution because you're trading one risk of RMDs for a different risk. Right now, inflation in 2021 is running at 4 to 5%. So if you put that money in cash, you are basically guaranteeing a greater than a 4% loss each and every year in purchasing power because of inflation. And so oftentimes, the wrong solution is to leave that money in cash. The right solution is continue to grow that money, but use Roth conversions as a tax solution early in retirement. So this scenario, for instance, that one we just showed, for the first 7 years of their retirement, we're having them convert a significant amount of those tax-deferred accounts. If we didn't, those tax-deferred accounts would just keep growing. And so we can deal with this issue right now with 7 Roth conversions. Given this person's situation. And notice what happens. This person is converting anywhere from $150,000 to $200,000 per year for the majority of these years. But look what's going to happen over here with the lifetime tax savings. Because it's going to keep them from being taxed at 28% here, and then at 33% here, it's going to translate to some massive tax savings. $1.5 million in tax savings in this person's scenario. Now, granted, this is more of an outstanding Roth conversion scenario. This person had some very significant pensions from different federal employee jobs that they had. Okay. And so these tax deferred accounts, these RMDs were just going to be tax hurdles that they would have to overcome. So completely eliminating those RMDs translated to some serious tax savings in this person's situation. So now we arrive at the question, great, I might have an RMD problem. How much should I convert? And again, this is going to vary widely. There are a million variables that feed into this formula on how much you should convert. I will say on average, the majority of you will not benefit from converting all of your tax-deferred accounts because some RMDs in most scenarios are a good thing. Because again, we have a standard deduction that we need to fill. So if we can fill that standard deduction with tax-deferred withdrawals from RMDs, that's a good thing. It means we're paying 0% on those RMD withdrawals. Even at 10 and 12%, that can still make sense depending on your scenario. For some of you, however, that have pension and Social Security income that fully covers your income need, you might want to convert the full amount. Now, how much you're going to convert in each year, again, will change depending on factors that feed into your situation. Like, are you on Obamacare? Okay, what is your current tax status? What is your current marginal tax bracket? Okay, how much should you convert? Will it cause you to owe Medicare increases? So there's so many variables that feed into this. Figuring out how to find the solution and figuring out how much you should convert in a given year will require much more analysis. If you're interested in figuring out exactly how much you should convert, in the description, you'll find the link to our website at www.safeguardinvest.com/contact. Fill in your information if you're interested in talking to our retirement tax team. We'd be more than happy to help you figure out how to improve your RMD problem with Roth conversions. Hopefully you liked this video. Hopefully it was educational. Always remember, you don't need more money. You need a better plan. If you like this video, don't forget to leave a like for us. Also, hit the subscribe button, be notified of all future videos that we release. Thanks for watching.